As US regulators go on the warpath against multiple cryptocurrency exchanges, the UK has an ambition to become a global crypto hub, but it has competition. The EU is soon to vote on landmark legislation to regulate crypto assets, and Hong Kong seems to be positioning itself as China's digital asset hub by proxy. Multiple jurisdictions are now deciding whether to ban this burgeoning but disruptive industry outright or bring it in from the cold. On this week's episode of the Crypto Mile, I am joined by Philip Hammond, former UK Chancellor of the Exchequer and now Chair of Copper, a City of London-based digital asset custody firm. Philip, welcome to this week's episode of the Crypto Mile.
Good to see you.
Thanks, Philip. Let us start with what is it that Copper actually does? Is it like a Web3 bank for digital assets? And why is traditional finance interested in gaining exposure into this high-risk asset class?
Well, first of all, Copper's core business is providing custody for institutional players who are trading in digital assets. And of course, at the moment, digital assets essentially means crypto. Hopefully in the future, digital assets is going to be an expanding asset class, which includes tokenized forms of many traditional financial assets. So Copper's core business is custody provision, and we expand out from there into post-trade settlement solutions and trading facilitation. So we have a product called ClearLoop, which enables clients to trade on multiple exchanges with very, very limited counterparty risk. Something that's very much uppermost in people's minds following the FTX collapse.
Can you give us an example of some of the digital assets that Copper at the moment have custody of?
Well, those assets would be crypto assets broadly, so cryptocurrencies, if you want to call them that. Bitcoin is obviously the largest by volume, but there are a whole range of assets which Copper holds on behalf of clients.
So recently I was speaking to members of the banking sector who said, yes, blockchain has its use cases, but then they said, no, crypto assets are useless, they're worthless and things like that. I had really nothing to really say about that, but if somebody said that to you, how would you respond to such a claim?
Well, first of all, the really important thing here, the structurally important thing for the future is the technology, the underlying blockchain technology. Right now, the only significant application of that technology in trading is around the trading of crypto assets. Now, I'm agnostic on whether or not crypto assets have a value. There's a market being made in them. Most of the big institutional players, high street names that we all know in the financial sector are involved in this market. This isn't just a market populated by peripheral players. It's clearly been colonized by the institutions. Most of the big banks globally are investing in developing their own digital capabilities. So I think this market is here to stay. And it's not really for regulators or others to say this asset or that asset has no value. An asset has value if somebody is prepared to pay for it. And if there's a marketplace to be made, then it needs to be a properly regulated marketplace.
Last year, Barclays invested in Copper, but this was at the same time when UK banks were trying to choke off the cryptocurrency sector by stopping payments and withdrawals to and from exchanges. Do you think we will see traditional finance gradually just assimilate this Web3 sector and leave these insurgents kind of still out in the cold? So sort of take the best of what the innovations have arisen in the Web3 sector and sort of throw away the worst?
It's clear that the original reaction of traditional finance was to try to strangle this digital revolution at birth. That was the instinct. I remember very well when I first became Chancellor in 2016, the conversation in the international meetings around crypto, central bank governors, finance ministers, was generally, this is a bad thing, how do we stop it? Even the 3 years that I was in that office, the debate moved from how do we stop it to how do we manage it, and how do we ensure that we can allow it to realize its genuine potential. Everybody recognizes that blockchain has the potential to deliver big advantages to markets. So where are the individual banks and institutions now. As with other technologies, fintech innovations, some of the banks think they can go it alone, do their own thing, develop in-house. Others have decided to partner with insurgents. Still others have decided to watch and wait and then acquire as and when they think it makes sense. I'm skeptical, frankly, of the ability of these very large, heavily regulated institutions to be able to develop cutting-edge technology internally. I think that's a difficult thing for them to do. And while some of them are trying to do it, even some of those who are spending a lot of money on that avenue are also now actively looking to partner with third parties, smaller companies, to try to get there first.
That's quite interesting because we've got the noise coming out of the Bank of England and the Treasury about a CBDC for the UK. Do you feel that kind of technology, that kind of infrastructure, you need digital wallet architecture, you need very robust blockchains. Do you think third parties should really take that on board rather than the incumbent institutions?
I think there's two separate questions here. It may be the incumbent institutions that need to own these innovations, but that doesn't mean they have to develop the technology themselves. Developing technologies and deploying technologies in large organizations with highly established cultures, shall we say, is challenging. Talk to anybody who's tried to roll out even moderately innovative IT solutions in big banks, and they'll tell you this is extremely difficult to do. So I think it's right that there should be a mixed economy here, with some of the big banks trying to do it in-house, some trying to do it by acquisition, some trying to do it by partnership. Let's see which model prevails.
So that reminded me of the collapses within crypto in 2022, culminating, as you suggested there, with the FTX downfall in November. Are these assets generally a systemic risk, really, to the global financial system? And incumbent institutions, really, to get exposed at this moment in time, it's still too risky?
So first of all, it's a good question. Are crypto assets a systemic risk for the system? The answer is no. At the moment, they're not. The simple scale means that they are not yet in any danger of becoming a systemic risk for the system. But it is something that the central banks globally are watching and will be very mindful of. If the value of crypto assets on balance sheets gets to the level where they could become a systemic risk, then that will call for an acceleration of the process of regulation and management of these markets. On the question you asked about CBDC, clearly, if we're going to expand beyond the current range of crypto assets into digitized markets for traditional financial assets through tokenization, then we need a means of settlement, and we need a means of settlement into fiat. That could be done with stablecoins, but stablecoins, because they are issued by non-sovereigns, introduce another tier of risk. As soon as you bring a non-sovereign into the equation, you create more risk. So yes, we would like to see CBDCs becoming available as the means of digital settlements in these emerging digital markets.
Do you think there's room, maybe in the next few years, for CBDCs to coincide with stablecoins?
Yes, of course. There's no reason why they shouldn't coexist, although I would expect that market actors, where they have access to CBDCs, all other things being equal, would choose CBDCs. And when I say all other things being equal, that means that the governments that are issuing those CBDCs are trusted by the users of CBDCs. And if, for example, governments that had issued CBDCs started to burn CBDCs that were held by people that they didn't approve of, that they sanctioned, for example, then that might undermine public confidence in a CBDC and redress the balance between stablecoins and CBDCs. But I think it's a marketplace, and ultimately, provided central banks that issue CBDCs are prepared to behave with proper self-restraint, I would expect CBDCs to triumph over stablecoins in the marketplace in the medium term.
Would you be for or against the programmability of CBDCs?
I don't think it's a question of being for or against anything. I think it's a question of exploring the possibilities, testing and trialing ideas in ideally a safe space, in a carefully designed and constrained environment, and looking at A, the risks, and B, the utility. And the test has to be, does it deliver significant additional utility? Clearly, if it doesn't, then there's no point. And does it introduce significant additional risk to the marketplace? And there has to be a judgment made about whether any additional risks are outweighed by additional utility.